following the presentation, judges will have a total of 5 minutes for questions. I will show time cards at various intervals to indicate the remaining time and will stop any speaker who exceeds the maximum time limit. No questions, comments, cell phone, or picture taking will be permitted from the audience. The audience will only be permitted to applaud following the question and answer period. The audience is banned from any material that bears the name or symbol of a competing university, and we also ask that the audience exit the room immediately following the question and answer period. Competitors, you may begin when you are ready. Western beer artisans, you've created a reputation of creating high-quality craft beer utilizing local resources. And that's a reputation that you want to maintain going forward. And that is your reputation beyond profits. So what's the next step? You want to expand operations. You may want to take over another company, another pub and brewery. How are you going to do that in the most tax-efficient way? And at the same time, you also want to keep in mind your main objectives as individuals as well. Good morning, Mr. Wall and Mr. Wilson. My name is Yufei, and this is my colleague Eugenia, and we're from Team KMA Consulting. And we want to thank you for inviting us to present to you our recommendations on your current situation, keeping in mind your objectives, but most importantly, minimizing your taxes. So let's get right into it. So here's our agenda for today. First, we're going to outline your objectives. Then we're going to analyze this current situation of Western beer artisans. And then we're going to talk about some of your personal tax issues that we want to touch upon and some tax planning opportunities that we have discovered for you. And lastly, we wanted to tell you how you can go forward and implement our recommendations, and we're going to conclude with a wrap-up at the end. Let's jump right into our first part. So your current objectives. Right now you have a successful business and you want to expand your operations. Also, as you expand operations, you want to eventually remove yourself from direct management. And how do you do that? Hire a general manager, like you mentioned, so that means delegating management. How are you going to do that? With all these, you want to minimize taxes. So those are your 3 main objectives. So with Western beer artisans, let's take a look at how you can utilize your company to purchase Don's Restaurant and Pubs, or DRB. So first of all, there's 2 options you have right now. You can either purchase assets or you can purchase shares. Which one should you go for? So as a buyer, you always want to purchase assets. I will tell you why. Taking a look at the pros and cons, when you purchase assets, you have a higher adjusted cost base because you're paying more for your assets. And so that means higher CCA that you can claim, which is a deduction, which is similar to depreciation expense. And also, you take on less risk because you're buying assets. You're not buying liabilities, nor do you have to worry about contingent liabilities as well. Also, because you're buying assets, you can choose which assets you want to buy. What if there's an asset in the company that you don't want? You don't have to buy that. You can choose exactly which ones you want to buy. Also, because you're buying assets, they're capital assets, they're much easier to evaluate. The cons for this is because when you buy assets, you're not buying shares. You can't capitalize on the opportunity called lifetime capital gains exemption. And that is $800,000 of capital gains that you can exempt from paying taxes on when you sell, say, shares, but it has to be qualified small business shares. So there's some sort of, there's a little bit of regulations with that, but when you're buying assets, you don't get that opportunity. Second of all, when you buy assets, you can't utilize losses. However, it seems that DRB is doing quite well. You don't expect them to have any losses, so this shouldn't be a problem. And thirdly, there may be a higher selling price just because of the higher ACV that you can get, as well as the increase of CCA deductions. Now let's take a look at the pros and cons of purchasing shares. So the pros, like I mentioned earlier, for the cons of the asset is that you can utilize your lifetime capital exemption, gains exemption, subject to a couple rules. And also, possibly a lower selling price as well. However, the cons for this is contrary to assets. So first of all, there's lower CCA because you're purchasing the shares of the company. So this ACV of the assets is transferred at the same amount. However, there is something called a bump. So you can actually increase from the ACV to the fair market value of non-depreciable assets that you obtain. But this only happens when you do a wind up, and we'll talk a little bit about that. So the second point is that valuation is very complicated. You're buying shares, especially CCPC or Canadian-controlled private corporation shares. What are they worth? They're not publicly traded. You don't exactly know. As well as there's contingent liabilities that are possible to be just outstanding. What are those worth? It could decrease the value of your shares that you may not even know. And thirdly, exposure to contingent liabilities, like I just mentioned, and also you would be assuming their liabilities. And on that balance sheet is $1.7 million of liabilities. Do you really want that on your books right now? So between the two options, there's purchase of assets and purchase of shares. We recommend purchase of assets. It is the most preferable for yourself as a buyer. However, there is a risk. Because Don is wanting to retire, he may want to get rid of his shares to utilize his lifetime capital gains exemption. So this is room for negotiation. This is a risk, but if you give him a favorable purchase price, he may be willing to sell his assets. Let's take a look at how you would structure this acquisition. So right now, Johnny and Bud yourself, you're owning 100% of Western Beer Artisans. And under that, you have the Happy Hopper Pub. So with DRB, how would you structure it? What we recommend is utilizing a holdco to buy DRB and not utilizing Western Beer Artisans to buy DRB. The reason for this is because you can separate the liability. If anything happens with DRB, if a customer gets sick and starts suing you the next day, the assets and Happy Hopper Pub will not be liable for anything that happens to DRB. And that's why we recommend using a holdco. The second reason for this is because interest is deductible. So right now, you want to finance your purchase perhaps with a bank loan. When you borrow money from the bank to invest in a business, that interest is deductible. So holdco can deduct interest, offset the business income from DRB with interest deductibility. So this will be the structure after you acquire it. So you will have two separate companies, Western Beer Artisans and the holding corporation. So with this way, you minimize risk, and also you can borrow funds to purchase DRB and deduct the interest. So what about bringing in the general manager as a shareholder? How should you do that? Right now, you're thinking of giving him an interest-free loan of 5%, for 5% share ownership. So there's a couple problems with this in terms of taxes. So right now, when you're giving an interest-free loan, that is considered an employee loan. Not only is there deemed interest at the prescribed rate of 1%, but there is potential for income inclusion as well. And I'll explain that in a little bit later. The alternative for this is employee stock options. We think this is a much better way to bring in the general manager as a invested shareholder that he cares about the profitability of the company as well. So let's talk about this employee loan. First of all, there's deemed interest. So at the prescribed rate, 1% of the loan of $55,000 means the general manager will have to include $550 of deemed interest in the year. And also, there's something called a two-column test. So for tax purposes, if it's an employee loan, the loan cannot be on two balance sheets. If it is, the full loan of $55,000 will be included on the general manager's personal income tax, pushing him perhaps to a higher tax bracket that he may not want. So this is something that's important. If you want to avoid that, you have to repay it. The general manager has to pay it by December 31st of 2015. So over 10 years, there's a $55,000 of income inclusion. Even though it's a 10-year loan, he has to include it within 2 years. So that is why employee loan may not be the best option. This is why we suggest having an employee stock option plan instead. So the stock option plan is basically a right to purchase shares in the future at a specified price for the general manager. And the good thing about being a CCPC is that if the stock options are issued out of the money, the the employee benefit can be deferred, so the tax on the employee benefit can be deferred until the general manager eventually sells the shares. And that is 50% of the employee benefit. So, and also, there is a lifetime capital gain exemption of $800,000 that the general manager can claim too, because now he's owning the shares of it. So when he does sell the shares of DRB or the holding company eventually down the line, he can utilize that $800,000 lifetime capital gain. So the good thing about employee stock option plan is that the employee, the general manager, can defer taxes until he eventually sells it, and he does not have to worry about deemed interest or having $55,000 included on his T1 individual tax return. So what would the new share structure look like? Just to outline it, Johnny, yourself, and Beth, you will still own 100% of Western Beer Artisans. And of course, you'll also own, collectively, 100% of the holding company that is with DRB. And now, now the general manager will be owning shares of the holding corporation over here on the right side. So this is the new share structure. He'll be coming in as a new shareholder. What we recommend is that you can issue him common shares that are not voting, so he doesn't eventually control the company or participating in the future profits of the company. So something that you mentioned during our last meeting is the scientific research and experimental development credit. What exactly is this credit? So this is short as SHRED. This is something that you can claim as a credit if you, say, improve the process of, say, your brewing process. So as a business, you have a corporate social responsibility to care about the environment. So this is something that's beyond profits. So right now, we know that brewing beer takes a lot of energy, it takes a lot of water. So if this is something that's passionate to you, you can invest in, say, scientific research and development to improve that process, make it more efficient. But keep in mind that this is not your main line of business. But if this is something you're passionate about, this is something we can look into for you. So, what is this investment tax credit that you can claim? First of all, there's a basic 20% of qualified SHRED expenditures that you can claim, with an option of going up to 15% for a total of 35%. Depending on certain regulations and expenditures, of course. There's a lot of rules relating to that. But the main key here is that if you're passionate about this, then you should go and do more research into this. However, because your main business is to create craft beer and to run a restaurant, so this may not be your main line of business, we do not want to deviate from what you are perfect and great at right now. That this is an option that you can keep in mind. So with implementation, in terms of implementation, we need to further investigate how to claim the SHRED credits and how to utilize the SHRED credits to offset any expenditures that you do use. So just to do a quick recap with Western Beer Artisans, first of all, you want to purchase assets and not shares. Second of all, you want to incorporate a holding company to buy DRB. Thirdly, you want to use stock option plans in place of an employee loan. Now, I'll pass it on to you, Gina, who will talk about some personal tax planning issues that you should have to your attention.
Thank you, Yifei, for introducing to you the ways that you can minimize the taxes and structure the business in order to minimize taxes, as well as take advantage of other tax some tax rules for you. And also let's take a look at the personal side of it that can impact your family and yourself. So you were wondering if you should also receive a dividend income other than salary right now. So there is a reasonable test in so right now you're receiving solely salary from your company, WBA. We think this might not be very ethical because it has to be reasonable for the salary because you don't want CRA to come back at you. You've been accurately and on a time basis claim the corporate tax return as well as personal tax return over the 15 years. So you don't want it to have a dispute with the CRA. So how to mitigate the risks of that? You want to get some bonuses as well. So there are some rules with the bonuses. You can actually claim or arrange a salary, arrangement deferral, which means that you can declare the bonus in a year and then get a deduction. But the receiver, so yourself, you, Johnny and Bud, also potentially the new general manager, they don't have to include this amount of the income, personal income, until when they eventually receive this bonus. So on top of these two things, reasonable salary, bonuses, make sure that you pay it within 180 days of declaring this bonus to mitigate the potential interest on this bonus, or the full amount inclusion on your T2 income return. So other than these things, you can also declare dividends to yourself, because there is no withholding taxes on the dividends. So that's definitely something that you should do as well. Also from your employees, the new general manager and yourself's perspective, pay enough salary and all of these remuneration, including salary, bonuses, as well as dividends, to maximize the CPP, so Canada Pension Plan, employee insurance, and also RSP, so registered retirement savings plan, the contribution room, because it's tax deductible and the income it's sheltered within until you eventually withdraw it. Hopefully at that time when you retire, when you withdraw the amount from the RSP, it's a much lower tax rate for personal income. Something to be aware of the dividends is that it's for shareholders only, and it's not, as I just mentioned, not subject to the benefits or the withholding tax. And it's more beneficial to keep in corporation because it's a CPC and you want to grow your business. So thinking from a business perspective, this is very vital to it. There is a potential risk of that. Just make sure, as I just mentioned, the salaries and expenses are reasonable in paying them out and in deducting them. Something to keep in mind, as you just mentioned, the farming income. There's a capital gains. You can utilize it to put into RSP or these vehicles. And also there's a $2,500 of non-capital losses that you can offset against your any type of income or capital gains. Also for Bud, there's an incorporated consulting company that has generated $50,000 of the loss. It is able to be used to offset any income or capital gain as well. So as we just look into paying the employee and also the shareholder remuneration, let's take a look at how you actually are going to implement this, our recommendation. So as I just mentioned, as my colleague Yufei mentioned, in acquiring DRB, WBA is going to incorporate a holdco to buy DRB. And also you're going to hire a lawyer for the legal, in order to prepare the legal documents to do all of these due diligence and valuation of the business to mitigate your risks. As for the general manager, you can hire him and then share employee stock options rather than a shareholder loan, or interest-free loan, in order to minimize his burden on his personal tax return. Because you don't want him to feel very happy at first of getting an interest-free loan, but later, when he finds out that it's included fully, he's not going to be happy about it. So your original purpose of rewarding your key employee as shareholders is going to be defeated, and you don't want to do that. So finally, is some personal issues, as we just talked about. So in the long term, you want to claim this stock option deduction, and we're going to help you with that as we are your tax advisor, and also utilize those losses from the consulting business for you, and declare the bonuses as part of your shareholder or employee owner-manager remuneration package. So let's take a step back and look at the big picture. You want to maintain a very strong financial bottom line, by minimizing taxes and also maximizing your profits. Good. So thinking from also the economic perspective, your company is producing craft beer locally, which benefits the local economy in the northern city, and also you want to terms of the ethics, you want to maintain your ethics, high standards of ethics by maintaining your previous years of regulation with CRA's rules. So this year, you don't want your employee, your new general manager, to be unhappy about the full inclusion of the interest-free loan. And finally, you are going to thinking about finally retire. And also, finally of all, in terms of environmental issues, we can definitely help you look into the SHRED thing as well. Thank you very much. We hope our presentation can give you a better idea of how to implement our recommendation. And we're open to the floor for any questions you may have.
Thank you. That concludes the presentation. The question and answer period will now begin.
So, you spoke about the mix of paying salaries and paying dividends to owners. Can you speak more specifically as to what combination of those two payment mechanisms you would suggest?
Sure. So now your company WBA has a net income every year of around $105,000. Assuming you're going to leave some of it to your company for the growth of your business, the rest, if you equally split between two, it's going to be $87,000 and $500 of salary to both of you, which is slightly above the the second highest person tax bracket. So we want to maintain your salary amount slightly below that, so that it's for Saskatchewan. We believe it's 13% of the producer tax credit, plus the federal is going to be 35%. Not tax credit, but tax rate. So you want to maintain the amount of salary below this bottom line, and the rest you can, as you are a new manager, you have the freedom to declare how much bonus and dividends you want.
Exactly. And like Eugenia mentioned earlier as well in the slides too, that we didn't have time to go into detail with. We did say you want to pay yourself a salary that can maximize your CPP, which is kind of the pension plan, as well as VI benefits, and to maximize your RRSP contribution room that Eugenia talked about. So you do want to mix both of salary to pay yourself enough salary to get those benefits, and then the rest you may want to pay out.
You had mentioned setting up a whole co to buy Don's business or
Right.
DRB. Did you consider at all having that whole co own the current business as well? And if you didn't, why not?
Well, first of all, the reason why we wanted you to set up a holdco to purchase the business in the first place is to keep those two businesses separate. The pub with the Happy Hopper as well as DRB, and that's for liability purposes. And the thing with that is that if one pub gets sued for whatever reason, the other pub and its assets are not liable, and that is why we don't want the one company to own both.
And would we, I think there's a preferential tax treatment on income below a certain amount. So if we have two companies, are we going to benefit from that in greater way?
Unfortunately, no, because the CRA is, if two companies are associated, which they are, two of you, Bud, and also Johnny, you both own two companies. So they actually share the small business deduction limit. So that's something you have to be aware of. It's $500,000. And so unfortunately, no, you don't get two deductions.
As a corporate owner shareholder, I've been told before that I was not eligible for EI. Have I been missing out on something? You mentioned EI in here a couple of times.
Yes, EI, employment benefit for corporations, they can pay you EI. You can elect out of it if it's your own company. That is an option. But you can also, you can pay into EI if you want. That is an option to elect out of it, though. That's true.
On the farm income, but it's capital gain of $200,000 at the highest marginal tax rate is the whole amount at the highest marginal tax rate. Or is it
The farming income.
Yeah, the sale of the farmland, but there's a gain of $200,000.
So the terms of capital gain, so that is just capital gain. What's taxable is half of it. So it'll be $100,000 is taxable capital gain.
If we're generating excess profits in our existing business and we want to reinvest that in our new company that we just bought, what would be the most tax-effective way of moving the cash from the one operating company to the other?
Definitely, because the two companies are connected or associated, what you can do is pay dividends to each other, and that's on a tax-free basis. So when you pay it more beneficial to transfer money through dividends between corporations.
I'm sure, you said you're gonna set up the whole going back to this about owning the new corporation, right?
Right.
Or the new company, and you're going to borrow to buy the new business. Now, would Holdco have any difficulties borrowing to buy the new business when really, when they go to borrow, Holdco is just gonna be an incorporation on paper?
Well, the thing is, when the bank looks at who's borrowing it, they don't just look at Holdco. Who are the owners? You, Johnny, and Bud. What else do you own? You also have Western Beer Artisans, which have a great reputation and a successful business at the moment. And they know that associate companies, you can pay dividends back and forth. So if you were ever in need or of the new Holdco to pay off any interest loans or payments, they have the help of Western Beer Artisans. So we think that wouldn't be a problem.
And then this way